What if one statement from one man could send tremors through every major financial market on Earth simultaneously? That is not a hypothetical question anymore. It is what just happened, and the speed with which global markets responded reveals just how fragile the entire system has become. The shockwave began with announcements from Donald Trump regarding trade policy, tariffs, and economic retaliation against nations he claims have taken advantage of the United States for decades. Within hours, currency markets, bond markets, and equity markets across Asia, Europe, and the Americas began moving in ways that caught even seasoned traders off guard. This is not simply about one policy or one statement. This is about what Trump represents in the current global financial order, and why his return to the center of American power has foreign governments and central banks scrambling to reposition. Let us be clear about what is actually happening right now. Trump has signaled his intention to impose sweeping tariffs on imports from China, Europe, and other major trading partners. Reports suggest these tariffs could reach levels not seen since the protectionist era of the 1930s. He has explicitly stated his willingness to use economic pressure as a primary tool of foreign policy, treating trade relationships as leverage rather than partnership. And he has made clear that the current international economic architecture, built over decades of American leadership, no longer serves American interests. In his view, the immediate market response tells you everything about how seriously global finance is taking these signals. The dollar experienced significant volatility as traders tried to price in scenarios ranging from trade war escalation to potential realignment of global supply chains. Bond yields moved sharply as investors reassessed inflation expectations, knowing that tariffs function as a tax on consumers that feeds directly into price levels. Equity markets saw rotations out of internationally exposed companies and into domestic-focused sectors. And gold surged, as it always does when systemic uncertainty spikes. The Federal Reserve finds itself in an impossible position once again. Chair Jerome Powell has maintained that the Fed does not make policy based on political considerations. But the economic scenarios now being discussed would force the Fed to choose between fighting tariff-driven inflation and supporting an economy potentially shocked by trade disruption. Sources familiar with Fed deliberations suggest internal discussions have intensified around contingency planning for trade war scenarios. The models they are running reportedly show outcomes ranging from mild stagflation to severe economic contraction, depending on how far the escalation goes. The Treasury Department is equally constrained. Secretary Janet Yellen has spent years building relationships with foreign counterparts based on the assumption of continued American commitment to the existing trade order. Those relationships are now being tested as foreign officials seek clarity on what American economic policy will actually look like. Reports indicate that several allied nations have begun preliminary discussions about reducing their dependence on dollar-denominated trade. This is not de-dollarization in the dramatic sense, but it is the kind of incremental repositioning that over time fundamentally shifts the global monetary balance. China has already signaled its response will be swift and significant. The People's Bank of China has tools at its disposal that it has been reluctant to use, including allowing the yuan to depreciate sharply, which would offset tariff impacts, but trigger capital flight concerns. Sources familiar with Beijing policy discussions suggest Chinese leadership views the current moment as requiring a demonstration of resolve. They remember the first Trump administration, and they believe showing weakness early invites further pressure. The European Central Bank is caught between maintaining price stability and preparing for potential trade shocks that could tip the Eurozone back into recession. European officials have publicly called for dialogue, while privately preparing retaliatory measures targeting American exports in politically sensitive sectors. This is the playbook from the first trade confrontation, but the stakes are higher now because the global economy is more fragile than it was in 2018. What makes this moment particularly dangerous is the intersection of trade conflict with existing financial stress. The global banking system never fully recovered from the regional bank failures earlier this year. Commercial real estate continues to deteriorate as loans come due on properties worth far less than their debt. Sovereign debt levels in major economies have reached points where interest payments consume growing shares of government budgets. And inflation, while lower than its peak, remains sticky enough to constrain central bank responses. Into this environment, Trump has introduced a variable that cannot be modeled or predicted using standard economic tools. He operates according to a logic that prioritizes leverage and negotiation over institutional stability. This makes him extraordinarily effective at disrupting existing arrangements, but also extraordinarily difficult for markets to price. The result is volatility not just in asset prices, but in the fundamental assumptions that underpin global trade. And finance, consider what foreign governments must now calculate should they accelerate diversification away from dollar assets. Should they front-run potential tariffs by stockpiling goods or shifting supply chains? Should they seek bilateral deals with Washington or coordinate resistance with other targeted nations? Every one of these decisions carries costs and risks, and every one must be made under conditions of extreme uncertainty about what America will actually do. The institutional breakdown this represents goes beyond economics. The World Trade Organization, already weakened by years of American criticism, becomes even more marginalized as major economies pursue bilateral confrontation. International Monetary Fund scenarios for global growth must now incorporate trade war possibilities that were considered remote just months ago. And the post-war economic order that America built and led faces its most serious challenge from within. None of this means catastrophe is certain. Markets have absorbed Trump shocks before, and the global economy has proven more resilient than many predicted. But each stress test weakens the system, and this stress test comes when structural vulnerabilities are already elevated. The question is not whether Trump can trigger financial shockwaves. We just watched it happen. The question is whether the system can continue absorbing these shocks without something fundamental giving way, and whether the institutions designed to provide stability have the tools and the credibility to respond when they are themselves part of what is being challenged. The answer to that question will determine not just the next market move, but the shape of the global economic order for decades to come. And right now, that answer is far less certain than anyone in power wants to admit.